Well, good afternoon. We're here at SuperInvestor in San Francisco 2013, and I'm talking with Jim Zenni, the founder and chief executive of Z Capital Partners, a distressed private equity investor out of Chicago. Jim, I'm especially delighted to be talking with you this afternoon because as we look at the returns that LPs have got from private equity funds, over the past dozen years, the most consistently good performer has been distressed private equity. It's been great for LPs. Are there still opportunities, or are they now, have we seen the best times for distressed?
It's a good question, and thank you for having me this afternoon. There's a lot of rhetoric about opportunities in distressed, and our focus as a firm is the middle market transactions, sort of below 500 million. The larger transactions that are more visible to some of the more trading or hedge fund type firms, or even Wall Street proprietary capital, or to some extent some of the control funds, it's a very difficult proposition for them because they're very visible opportunities and they're very easily accessible. For those firms who source transactions sort of away from the Wall Street grid, both trading desks and bankers, there's a large opportunity set. Today, there's about $300 billion alone on commercial banks' balance sheets that are criticized.
And that's the market you're in. It's the mid-market. It's away from the public view, as it were. It's below the radar.
Typically, it'll be balance sheets of companies that were acquired by private equity firms, traditional private equity firms, possibly in this last cycle. And the balance sheets are relatively simple from a structure standpoint, where they'll have obviously equity from LPs, maybe some mezz debt, and at the top of the capital structure you'll have senior secured debt, supplied by a group of typically a club commercial bank deal, maybe a dozen banks, maybe 20 banks. But these are loans that are not syndicated to typically CLOs or bond funds or loan funds, but they're syndicated only to a very small group of lenders. They're not looking to have a tradable market in them, and they're not loans that are rated by the rating agencies,
right,
which restrict the liquidity and also don't show up.
Restrict the possible buyers.
Exactly.
Yes.
Exactly.
Yes. Now, one of the things that fascinated me in the panel discussion that you were part of earlier was looking at the recent issuance of corporate debt. And how it's, after, the tremendous fall off after the global financial crisis, we're right back to where we were. And in fact, we last year was, I believe, in certain categories, an all-time record.
No.
So,
in all categories, it was an all-time record, actually. We think of it this way. We're in 2013 today. 2012 is the time frame you're referring to. Very different economic backdrop last year than in 2007.
Yeah. We
had economic growth. We had basically full employment. Europe was still growing, et cetera, et cetera. Today, Europe's not growing, very high unemployment, very depressed housing values. But yet, last year, they issued almost $900 billion of high-yield bonds and levered loans. But keep in mind, about 60% of that issuance was for refinancing of prior deals, which basically sort of extend maturities and also fix potential financial covenants breaches.
Is this the extend and pretend?
To some extent, yes, it is.
Yes.
Yes, it is.
Now, being a layman, just looking at the history of good returns in distressed debt, the fact that when you talk to LPs, as we do all the time, distressed is one of the areas they're most interested in and want to get into. And then the figures you showed earlier today showing the record volumes of new debt being issued, which can clearly lead to more distress in future. Would I be wrong to conclude that the flow of opportunities in distressed is going to continue unabated?
We certainly believe that there's a bubble being created today. And if you look at the amount of leverage on balance sheets of recent deals, the leverage is creeping up again, once
absolutely,
again.
Yeah.
I don't think anybody is buying into a strong economic growth pattern, but yet lots of leverage on companies, even new deals. When leverage is available, traditional private equity firms will use it. And it has been available in very large amounts. So yes, we believe that not only is there a huge opportunity set for the middle market today, but I think it's one that's going to be developing in a few years.
People have very short memories.
They do. It's incredible to me.
But every cloud has a silver lining.
It does. It's, so we have a tendency to have good times, but better times in some cases. Yeah.
Jim, can we talk briefly about Europe? Because you're mostly focused in the US. There's a lot of talk about distressed in Europe. Do you see opportunities there, or are there more opportunities right here in the US?
In Europe, it's tricky. We typically will only focus on US companies. There will be an occasion where we'll have a company that has a European subsidiary. Bankruptcies are very difficult to navigate in Europe. Company files for bankruptcy in one country, typically they'll have subsidiaries in other countries. So now there's 4 or 5 different separate bankruptcy proceedings at one time, very complicated. The laws are very unlike the US. And frankly, the banks are far less pressured into writing off loans or selling loans at a discount.
So the amend, pretend, extend is even worse in Europe.
It's even worse it's even worse in Europe. Now we are trying to source transactions, loans from European banks that were once very active in the sponsor space to private equities sponsors in the U.S. So we have gone out and made inroads into discussions with some of the foreign banks that once had very large sponsor activity here for U.S. loans that now reside on European banks' balance sheets.
Right. Jim, thank you very much.
No, thank you very much.
Thank you.
My pleasure. Thank you.